On June 12, 2026, SpaceX successfully completed the largest public stock offering in financial history on the Nasdaq. Shares opened at $135, raising $85.7 billion in fresh capital. Total orders reached $350 billion, with $100 billion from retail investors. Following the IPO, extreme demand pushed the price to a peak of roughly $225. Elon Musk retains an approximate 42% ownership stake in SpaceX. At that specific peak price, his estimated paper net worth momentarily crossed $1.3 trillion. But tying a trillion-dollar valuation to a volatile opening week stock price rests on highly unstable ground. How does a founder actually utilize a trillion-dollar net worth if they don't take a traditional cash salary? Instead of selling shares for cash, they borrow against them. This approach avoids massive taxable events and bring power in the company. To understand billionaire wealth, you have to ignore the headline net worth and look closely at the mechanics of their debt leverage. That leverage carries a specific structural risk, known as a margin call. The loan amount is a fixed obligation. If you borrow $3.5 billion, you owe $3.5 billion. But the collateral securing that loan fluctuates daily. If that collateral's value drops below a threshold, the borrower faces forced asset liquidation to cover the shortfall. We can see how this works by applying a hypothetical 80% loan-to-value limit to a $3.5 billion loan. To satisfy the lender, the borrower needs at least $4.4 billion in collateral. Musk currently has roughly 236 million Tesla shares pledged. Distributing that $4.4 billion requirement across those shares sets a strict price floor of about $18 to $19 per share. Tesla stock would have to plummet over 95% from recent highs to hit that red line and trigger a forced sale. Highly conservative loan-to-value ratios are intentionally engineered to absorb massive market volatility without putting the founder's core assets at risk. Using stock as collateral for personal debt is not a sudden pivot for Musk. It has been his primary financial strategy since Tesla's early days. As far back as 2011, Tesla's public SEC filings formally disclosed that Musk had pledged shares to Goldman Sachs. Those early loan terms contained the exact same forced liquidation clauses tied to severe drops in the stock price. While the absolute dollar amounts have scaled up by several orders of magnitude, the underlying financial engine has remained identical for over a decade. The leap toward a trillion-dollar mark began before the IPO. In February 2026, a SpaceX and xAI merger created an entity valued at $1.25 trillion, with Musk holding a 42% stake. By May 20th, that target jumped to $1.75 trillion. While the private space company surged in value, concurrent legal and corporate events were multiplying his wealth at Tesla. In December 2025, the Delaware Supreme Court issued a ruling that legally restored over $120 billion in previously voided Tesla options. A month earlier, shareholders had voted to approve a new, forward-looking pay package tied to future milestones, valued at up to $1 trillion. These overlapping corporate restructurings and legal victories acted as simultaneous multipliers, massively inflating his total paper wealth all at once. Because this wealth is concentrated in newly public, highly volatile stock, calculating a definitive single number for his net worth is mathematically impossible. During the peak of the IPO, major financial data providers showed a staggering discrepancy, with estimates ranging from $700 billion to $917 billion, a gap of over $200 billion. Even with an enormous paper valuation, Musk has historically described himself as cash poor prior to major stock sales. A trillion-dollar fortune built on paper is not a verified bank balance. It is a fragile mathematical estimate, capable of evaporating by hundreds of billions of dollars in a single week. Look at this NASDAQ ticker board from June 2026. Shortly after SpaceX completed its initial public offering, shares of SPCX peaked at $225.64. At that exact pricing, Elon Musk's paper net worth crossed $1.3 trillion. This chart tracks that stock over 30 days. The peak held for a few trading sessions before plummeting to $115 a share. Because his fortune is tethered to this single equity, that decline erased $612 billion from his ledger. A fortune of this size does not exist as cash in a vault. It exists almost entirely as locked equity, meaning the shares hold theoretical value, but purchasing power requires a specific financial mechanism to unlock. To cover his actual expenditures, Musk relies on margin leverage. He pledges his shares as collateral for massive bank loans, securing liquid cash without selling the underlying asset or triggering capital gains taxes. The trade-off is that his borrowing capacity remains completely exposed to the daily swings of public market sentiment. For 26 long years, Jeff Bezos operated an entirely opposite financial model to fund his own space venture, Blue Origin. This represents his historical playbook. Rather than borrowing, Bezos executed a planned sale of $1 billion in Amazon stock every year, funneling the cash into Blue Origin. By paying capital gains taxes, he accepted friction to buy immunity from margin calls and volatility. Leverage builds purchasing power rapidly, but invites extreme downside risk. Routine cash sales offer predictability and safety, a system that works perfectly as long as the costs of the project remain stable. On May 28, 2026, the predictability of that system ended. During a static engine test in Florida, a Blue Origin New Glenn rocket suffered a catastrophic structural failure, destroying the vehicle and Launch Complex 36. The physical destruction required immediate, unplanned cash to repair, adding well over $1 billion to the company's expenses. Blue Origin's required capital expenditure for the year suddenly climbed to $4.8 billion. Stacked against Bezos's historical $1 billion drip feed, the math failed. The explosion created a $3.8 billion deficit his yearly stock sale could not bridge. Closing a gap of that size quickly through the old method would require a massive, abrupt sale of Amazon shares. In public markets, a sudden multi-billion-dollar founder sell-off signals internal distress and creates downward pressure on the core company stock. This highlights the structural difference in how these two empires are valued. SpaceX's worth is traded continuously by the public market. Blue Origin's valuation is set privately by its founder and locked in place until the next formal round of investment. A slow, steady billion-dollar drip feed was incapable of surviving a sudden physical catastrophe. The deficit required Bezos to abandon a quarter-century of financial isolation. To cover the repairs and keep the company moving, Bezos opened Blue Origin to outside investors for the first time. This graphic represents the $10 billion funding round, negotiated at a private valuation of $130 billion. The hedge fund Co2 Management committed $4 billion, and institutional investors provided another $4 billion. To close, Bezos anchored the deal, contributing $2 billion personally. In high finance, asking outside institutions to fund a cash-burning business requires the founder to show serious skin in the game. Writing a 10-figure personal check alongside outside money proves the founder expects the equity to grow, rather than looking like an exit strategy from a struggling project. To source that $2 billion, Bezos abruptly accelerated his Amazon stock sales, unloading $4 billion in shares in a single move. He executed this $4 billion sale right as Amazon posted strong second quarter earnings, reporting $200 billion in revenue and $5.75 per share. Even against strong corporate earnings, a surprise stock sale from a founder creates a psychological drag. On live television, commentator Jim Cramer described the timing of the massive sale as a buzzkill for the market. Converting locked paper equity into physical reality is the ultimate bottleneck of the ultra-wealthy. Musk attempted to bypass this friction using debt and suffered a $600 billion whiplash. Bezos paid the friction tax for 25 years, until a physical disaster forced outside ownership and massive sales. Gravity, whether on a stock chart or a launchpad, eventually collects its due.